How did World Bank loan conditions affect national sovereignty? Have you ever wondered how financial support from the World Bank impacts a nation's ability to make its own decisions? This question leads us into the heart of the World Bank's role in global finance and its influence on national sovereignty. When countries seek loans from the World Bank, they often encounter specific conditions, known as conditionalities. These requirements can significantly shape the policies that governments can pursue. Essentially, these conditions can limit the choices available to a country, reducing its control over domestic economic and social decisions. The World Bank's mandate focuses on promoting economic development and reducing poverty. To achieve these goals, the bank provides financial assistance along with policy advice. However, to ensure that loans are repaid and that the intended economic reforms are effective, the bank attaches conditions. These may include fiscal austerity measures, privatization of state-owned enterprises, trade liberalization, and changes in social spending. While these reforms aim to stabilize economies and improve competitiveness, they can also constrain national sovereignty. For instance, a country might be required to cut public spending on essential services like health and education to meet fiscal targets. This can hinder its ability to provide necessary public services, limiting its freedom to pursue its own development priorities. Historically, the practice of conditional lending gained prominence during the structural adjustment programs of the 1980s and 1990s. During this time, the World Bank and the International Monetary Fund worked together to restructure economies facing debt crises. The conditions attached to these loans were often stringent, including currency devaluation and deregulation. While these measures aimed to restore economic stability, they also raised concerns about the erosion of national sovereignty and the social costs for citizens. Interestingly, some evidence suggests that when designed thoughtfully, these conditions can lead to improvements in social policies and institutions. For example, they might enhance social protection systems or promote environmental sustainability. This shows that the right kind of loan conditions can help countries achieve their development goals, although the balance between external influence and national autonomy remains delicate. In practical terms, the influence of World Bank loan conditions means that governments often find themselves negotiating between accepting financial support and maintaining control over their policy decisions. This dynamic reflects a tension in international finance between the goals of economic stability and growth and the principle of sovereign self-determination. In essence, World Bank loan conditions have historically affected national sovereignty by imposing policy reforms that limit government discretion, especially in economic and social policy areas. While these conditions aim to promote sustainable development and fiscal health, they also raise important questions about how much control countries can maintain over their own development strategies within the global financial system. This interaction is a significant chapter in the history of international financial institutions and their role in shaping national economies.